Good day and welcome to Nature's Returns, a webinar speaker series hosted by the Yale Center for Business and the Environment. My name is Charlie Governale and I will be your host for today's webinar, which is titled Driving More Sustainable Agricultural Practices at Scale, Harnessing the Market Power of the World's Largest Food Companies. The Nature's Returns webinar series invites leading practitioners and researchers in the field of conservation finance to talk about the latest opportunities and developments in the growing field of ecosystem service valuation and investment. Today, we will explore a suite of private sector approaches for driving more sustainable agricultural practices at scale. In order to drive more sustainable agricultural practices, we need many different stakeholders to chip in. When we talk about private sector opportunities, we often focus on shiny new solutions coming out of venture capital-backed startups and innovative investment shops. Meanwhile, we often overlook the potential role of the largest corporate players in the food system, whose small actions can achieve impacts at massive scale. In this webinar, we join the Sustainable Food Lab on a deep dive into their work with multinational consumer goods companies on a toolkit of low visibility but extremely powerful levers for change. Before we begin, we'd like to remind our listeners that we welcome any questions you might have. Please type questions directly into the Q&A window at any point throughout the presentation. We will aggregate questions and share them with our speaker after the end of her talk. We have approximately 20 minutes planned as a Q&A session after the presentation, so please stick around to hear responses to our questions. To open our webinar, I would like to introduce Elizabeth Reeves, Senior Program Director, Agriculture and Environment at the Sustainable Food Lab. Elizabeth directs the Sustainable Food Lab's efforts to develop landscape-level collaboration for sustainable agriculture in large-scale grain and livestock systems. Elizabeth, welcome to Nature's Returns. I'll turn it over to you.
Can you hear me? Looks
yeah,
good.
Go for it.
Wonderful. Thank you, and hi to everyone. I can't see who's on the line today, but I'm welcome and I'm grateful for this opportunity to share a little bit more about the Food Lab and really what we're learning about the ingredients for successful supply chain programs. So just a little bit about the Food Lab. In case you have sort of a mental image in mind of test tubes and beakers sort of mixing up new food flavors, that's not quite what we are. We're actually a social innovation lab, so mixing up people in landscapes in different farming communities. We work globally and we work directly with companies to connect the investments that they're making in climate mitigation and adaptation, reductions in greenhouse gas emissions, soil health, poverty alleviation in their supply chain or living income directly to farmer-facing programs. We also frequently find that we need to work and lead pre-competitive collaborations within sectors to address specific barriers that are hard to overcome by single supply chain initiatives. So things like market development for extended crop rotation, tool and metric implementation and deployment, or sector alignment on goals in a particular commodity or landscape. Charlie alluded to it in the beginning, kind of like, so why are we talking about supply chain programs on a conservation finance webinar series? But we know that there are a few key levers that can help scale sustainable agriculture globally. There are levers such as policy, market creation, so carbon markets, and other types of finance, which I'm sure have been introduced on other webinars that you've hosted, and supply chains. And supply chain work is often a weak spot or it's overlooked. And it shouldn't be, because companies are making all sorts of social and environmental commitments. And in case it's not obvious, which I think it probably is, these large multinationals touch a lot of acres and a lot of farmers through their supply chains. So the potential there to harness this reach and leverage it for agriculture not to do just less harm, so less water use, less synthetic inputs, but also to do more good. So, the opportunity for soils to sequester more carbon, increase biodiversity, produce more food, get more resilient to future shocks is really big. And at the Food Lab, the thing that we care most about, our passion, is really healthy farming systems. And we know that there are lots of amazing farmers out there with inspiring soil health stories. Maybe you've even heard from some of them on this webinar series. Those farmers are typically pushing against economics, and they don't always represent the mainstream. So in large-scale commodity systems, we really need to figure out ways in which we can make these practices, these conservation practices, these sustainable ag practices pay. And to do that, we need to work with companies. So I hope today to really give you a view of what drives, first kind of what drives farmer decision-making, and then what's being learned from farmer-facing supply chain initiatives that needs to be put together to make programs that really support farmers to overcome some of those barriers. And then I want to bring in price uncertainty and economic incentives so that we can really understand how to connect programs to buying practices to finance. I'm going to, just to give a little context and kind of contextualize some of the examples that I'm going to use. I lead most of our large-scale grain and livestock work, so professionalized ag systems at the Food Lab. So I'm really going to use examples from my own experience, in particular in the US Midwest corn soy system, and in the wheat belt from Australia. My colleague Don Seville, I think, is on the phone. I'm not sure. He leads all of the Food Lab smallholder ag work. And so if there are particular questions around smallholder ag systems, he can help contextualize any of that discussion when we get to the question time at the end of the webinar. And I also want to clarify what we mean when we talk about conservation practices from my perspective. So I know that conservation finance can mean many different things. And so in this case, when I'm talking about conservation practices, I'm mostly talking about nutrient use efficiency, cropping practices like cover crops, minimal soil disturbance, and extended rotation systems. And when I'm thinking about conservation finance, I'm really thinking about how buying practices can help farmers address risk and create market pull that can also be used to leverage other types of finance. So supporting some of those other types of lending products and innovations that I think you've talked about on previous webinars. But to do all that, I think first I want to take us through why farmers do what they do and how we need to design programs and create financial mechanisms to help them overcome some of the barriers that get in the way of large-scale adoption. So we love to talk about the potential for the world's agricultural soils to sequester carbon and reverse climate change. And so while we're all very optimistic and hopeful for that future, the science for measuring carbon increases in soil is still relatively a dark art and generally debated. So we're still trying to get better at our understanding of what that potential is and how to measure it and how to make it cost effective. But what is agreed on is that there are very sort of the agronomic benefits, so the clear short-term and longer-term agronomic benefits of investing in these types of conservation practices. So what does that mean from a farmer point of view and from a company point of view? In the short term, things like cover crops, minimal soil disturbance, extended rotation can help break pest and disease cycles. So from a farmer perspective, that means being able to save money and reduce herbicide and pesticide use. So, and from a public good perspective, that means that there's less toxicity generally in the system. Farmers are able to improve timing of planting and other field work. So from a stability of supply or a security of supply, or reducing variability in cropping years, that improved timing of planting is another benefit. And then being able to reduce input costs. So where farmers are able to to reduce primarily their use of synthetic fertilizer. And of course that has greenhouse gas benefits as well as water quality benefits. In the long term, these practices will result in improved productivity in bad weather years by reducing the variability across fields. So this is great when we think about in the US last year and likely this spring as well, just the intense flooding and the cold and wet springs that we've been seeing become more of the norm in our farming system. And hopefully in the long term, we're going to start to see some other sustainability benefits from improved soil health. So better water use efficiency from the soil, so more moisture conservation or better infiltration into wet years, improved biodiversity, improved water quality, and potentially higher farmland values as yield and profitability are able to be maintained through improvements in the soil, as well as access to potential payments for ecosystem services and avoided regulation. So, farmers are frequently targeted for regulation around whether it's water quality, and there could be a time in the future where they're regulated for greenhouse gas emissions as well. However, the reality is, for most farmers, they bear all the costs and risks of adopting or implementing these new practices. And the system on its own does not incentivize them to really do things differently. So farmers operate in a low margin, high input, price volatile business environment with increasing variability between too wet and too dry years. And farmers in professionalized agriculture systems typically operate with a large line of credit as part of their annual production loan. And so I threw up this, this table that goes back to 1970 from the USDA that shows that over time we've seen really farmers increase their debt to income ratio, while farm profitability has remained relatively unchanged or increasingly negative. And I threw in a similar graph from some work that we're doing in Australia in the wheat belt, and you can see that this increase in debt to income ratio is really, it's not an artifact of just a subsidized farming system like we have in the U.S. Australia is a non-subsidized farming system, and we can see the same trends. And go ahead, Charlie.
Okay, I was just going to say, for those of you just joining us, just wanted to refresh, we're here with Elizabeth Reeves from the Sustainable Food Lab, and we're talking about harnessing the market power of the world's largest food companies to drive more sustainable agricultural practices at scale. Thanks for joining us, and Elizabeth, I'll turn it back over to you.
Great, and I just wanted to say that one of the points to be made here with this chart is that is really that as we see more climate shocks, so in Australia, fires, 3 years of one of the worst historic droughts that they've ever experienced, or wetter springs and more intense flooding in the U.S. In the U.S. Corn Belt, this kind of fragility in the farming system really makes the costs and risks of trying something different both harder and also sort of a more urgent and bigger opportunity for us to unlocking. And so all of that being said about the benefits, again, I'd just like to bring us back to some of the challenges. I mean, and I think these are some of the challenges that other speakers have brought up on previous webinars and when they've talked about the types of innovation. But really, currently, there's no market for soil health, and farmland is still potentially getting higher land values for doing improvements on their land. Farmland is still mostly traded on productivity indexes and comparable market values. We also know that this price and yield risks associated with weather and commodity markets are managed through crop insurance, which really rewards productivity, and also that those risks, even in crop systems without good crop insurance or subsidized crop insurance, pushes farmers to really try to maximize production for those good years so that they can make up for losses in the bad years. And that while markets for ecosystem services and carbon credits for farmers are emerging, the potential benefit from these might be limited, and they have, they're still in pilot stage. So we're not exactly sure, what the potential is in a really rich organic matter system like the US Midwest, where farmers, even after years of mining soils, still have, about 5% organic matter versus the ability to access those credits in places where soils are much more depleted and the opportunity to build them back might be bigger. So the main point that I just want to hit home is that farmers do things for good reasons. And when we design supply chain programs and we design different types of finance mechanisms, that we need to understand kind of why farmers are already doing things and what the barriers are for them to change those behaviors. So just to bring back that cover crop example, or the example of the spring flooding in the US Midwest last year, we know that most practices, most of these conservation practices add costs and come with risks, in particular as farmers go through a transition period to learn how to adapt into their farm and seasonal conditions. So if you were a first-time cover crop farmer last year, we saw that, for those farmers who were able to get their corn planted, that planting happened much later, and harvest happened much later. And it was also a cold and wet fall, so it made harvest tricky. And if you have a very small window to get, that means farmers had a very small window to get their cover crop established before it got too cold or they lost moisture. So if you're a farmer and you're spending, anywhere between $40 and $70 an acre to put a cover crop in, and it's your first time, and harvest is late, and you're, you can't, you're trying to pull the combine off and get the seeder back in. Like, there's quite a bit of risk that comes along with that cost. So you might not even get much establishment for your cover crop in that year. So we need to take those kinds of things into account when we scratch our heads about sort of the obvious benefits of practice, and don't think about the costs and risks. And then around markets. So again, I'll use the Corn Belt example, where, farmers grow a whole bunch of different crops, but as livestock left the farm and there became less market opportunities for things other than corn and soybeans, farmers really moved away from growing things like oats and wheat and triticale. And so the result is that we have a system now where there's just crops growing on the landscape during the warm season months, and that the landscape is bare during the rest of the time. And so if we could bring a small grain back into that system, so, increasing markets for feeding small grains to livestock, or making granola bars and oatmeal and oat milk out of oats, then we can give farmers a reason to grow something other than the crops that they have, that they know that they have market outlets for. So and the same thing is really true in the Australian context, where one of the key things that farmers need to improve their soil health is a pulse crop in their rotation. But chickpea and lentil markets are very volatile. They're dependent on export markets, which means they're dependent on bad years in other countries that typically produce chickpeas or lentils. And so there's not a whole lot of incentive for farmers to kind of go all in terms of planting that pulse crop in the system. And the third example I'll give is just price uncertainty in cash crop markets. I've talked about this already, but it really drives production maximization for farmers to bank money in good years and make up for losses in bad years. And I'll give you all a link to this. I'll have Charlie send it around after the webinar, but there's a really great economic analysis that Iowa State just did about sort of the economic incentives, or the relationship between price uncertainty and crop insurance, and how that drives farmers to over apply nitrogen fertilizer. So just Typically, around the world in most systems, the equivalent is of the land grant universe always publishes kind of what the maximum return to nitrogen is for different crops. So what is the sweet spot in which farmers can apply fertilizer and expect a good return? And then there's diminishing returns beyond that. However, what happens is that fertilizer application typically occurs before a corn crop is marketed. So the decisions around how much fertilizer to apply are made with a lot of uncertainty about price or crop prices. And the wider the range, so what the Iowa State study shows is really that the wider the range of price uncertainty, the more profitable the range is for N application. So in a good year, a farmer can typically recoup all of their additional dollars that they spent on that extra fertilizer through an increase in yield. And then sort of to buffer that decision for bad weather, farmers purchase crop insurance. And crop insurance pays farmers out based on annual historic production. So again, the higher yields that farmers can achieve in their good years, the better the potential insurance payout is going to be in a bad year. So you can just see how price uncertainty is really this reinforcing cycle. And so for very rational reasons, farmers are making choices to over-apply fertilizer, essentially as a risk mitigation tool. And then not to be undervalued is the social and cultural pressure that farmers face in their communities to keep farming the way their grandfathers farmed and the way their neighbors are currently farming. So being able to provide farmers with networks of other farmers that are also innovating alongside them, and to be able to learn from each other's mistakes and successes is a really important part of sort of inspiring and supporting farmers along their conservation practice adoption. So for successful supply chain programs, we really want to, if the goal is farmer adoption of conservation practices, we really need to design those programs with the farmers in mind. And so we need to take account of what the barriers are and what the incentives are that are sort of driving decision making, and what types of program support are needed to really help overcome and provide the right kinds of building blocks to support that farmer adoption. So some of the really obvious ones, which we see in the more successful supply chain initiatives, are sort of packaging technical assistance with those farmer learning networks to provide inspiration, making sure farmers have access to infrastructure and equipment, so that convenience factor to be able to get the work done that they need to get done, and providing some sort of risk mitigation. In the US, it would be in the form of, cost share, so linking farmers to equip dollars to help them over the short term get some sort of cost and risk share for adopting new practices. But what we frequently have a challenge with, and sort of the toughest nut to crack, is what also drives farmer decision making, which is this not price necessarily, but that margin between price and cost of production. And in most of our commodity systems or commodity markets, they really default towards the least cost system. And in addition to that, the level of uncertainty that's associated with that margin. So, one of the challenges of trading in products that are influenced by commodity markets is really to kind of understand what that fair price might be. And commodity exchanges, while they serve the purpose of price discovery, they really don't ever sort of balance the market based on what we know about cost of production. So what does that mean? So we know that what's needed, really kind of know what's needed to design good supply chain initiatives. Within companies, this is typically done as a relation or an investment in sustainability through the sort of the sustainability teams in the business. We know how to lead pre-competitive sector initiatives to try to, whether it's around collaborations to develop new tools or to address some of the structural or landscape level challenges that one company can't tackle alone. Those I think we've developed some pretty successful models for. It's when we get to coupling those supply chain initiatives, so those kind of core program elements with business practices, that we really get stuck. And it's frequently the hardest nut to crack, both around how to make sure farmers have some price stability or less price uncertainty and some sort of risk share through the way in which companies buy from them. And this relates mostly to procurement and can be challenging in companies where commercial and sustainability are separate. And that kind of leads us to the finance piece. So what types of mechanisms, so what types of buying practices are really needed to help farmers overcome some of this price uncertainty and risk? And the first thing we have to remember is that not all practice change is the same. So we need to design those contracting mechanisms and those risk share mechanisms with that in mind. So targeting the approach about what's needed to make a more effective type of change. So typically at the Food Lab, we sort of have this typology of kind of three types of practice change. So there's that win-win where, really farmers know how to do it. And it doesn't cost them that much more. And they just need their customer to ask them to do it. There's the worse before better scenario, which is a lot of the examples that I've already given. So getting cover crops to work in your system, adoption, integrating livestock back into your farming system. And really that's kind of where we need to focus a lot of our efforts, which is medium term market pull and cost and risk sharing. And then there's occasions when practices just result in a higher cost of production. So the classic example is organic, and this is when new business models are needed to really reward that different kind of production system. And so for our win-win situations, really all we need are kind of standards and compliance to help get us to that next level, so checklists. With the worse before better scenario, there are a whole host of places where I think we could start innovating, tying good supply chain programs to better risk share mechanisms. And so this can be done through forward contracting, contracts with minimum price guarantee, the use of cost plus pricing models, yield risk insurance, and other types of lending mechanisms that can be done through commercial contracts. And then higher costs of production models typically fall into the fixed premium or flexible premium bucket. And we have some good examples already, and I want to go into those. I'm just going to check the time. I want to spend a little bit more time to get kind of interesting. So from a cost plus pricing perspective, we could think of Danone or Costco as having some really good examples of a cost plus program. And there's some trade-offs, both for farmers and from a company perspective in setting up these kinds of models. But this is a cost plus model really sets the purchase price by taking into account the changes in the supplier's raw material costs. So in the example of milk, if the price of corn increases, so the price of feed increases. So then a company like Danone, who has a cost plus program, will also raise the price at which they buy that milk. So farmers in this case are paid a guaranteed fixed margin on top of the variable production costs, kind of typically under a maximum price ceiling. And margins are set based on negotiations with the individual producer. But this arrangement really allows producers to focus on production. They can invest in new types of practices and know that they have some market assurance, as well as a buyer that's willing to help invest alongside them. So farmers commit to being a reliable and efficient supplier, and customers commit back to farmers to kind of support them along that journey. Another great example, so I mentioned markets and the need for markets in help creating more crop diversification in our very efficient monoculture system. So Oatly, the oat milk producer, you probably know them for all their sort of cheeky advertising. But they want to be able to use their purchasing power, so buying oats, to help bring about more landscape change in the U.S. Corn and soybean system. They know that they recognize that farmers who haven't grown oats for a while have some risk involved in trying that out again. In particular, in the first couple years, it can be hard to get your oats up to quality and spec. So as a result, Oatly's created a program in which they have made a longer term commitment to farmers, as well as a sort of a minimum price guarantee based on what we know kind of costs of production are, and kind of that margin guarantee that farmers need to help them feel confident that they to make the shift and get into the market. And they've coupled that directly to a program that's going to offer good coaching and technical assistance for farmers alongside some of that contracting security. And another great example of how we can use finance mechanisms is through creating kind of novel lending products is the Glanbia Milk Flex Fund. So Glanbia is I think Ireland's largest milk co-op, and their farmers are all grass farmers. So for their farmers to invest in increasing productivity as well as improving the sustainability of their operations, they really needed those loans to be to be tied to sort of a more flexible structure that triggers different repayment schedules based on market fluctuations. And so this gives farmers some relief throughout the year, and some assurance to know that if milk prices go down or supply demand changes, that they have some flexibility in their repayment schedule. So that's another really great example. And then I think Friesland Campina is a traditional milk co-op in Europe. And they have developed a flexible premium structure for their farmers that's really based on a point system. So farmers, meet a minimum threshold, and then any farmer that sort of invests in a whole suite of practices above and beyond, and kind of the minimum can get a payout or a premium payout based on how well they score. So farmers kind of have a choice on how much investment they want to make at one time to recoup those premium payments. And another great example of would be Anheuser-Busch that just launched this year their Michelob Ultra Pure Gold, which is an organic beer. And they recognized that farmers needed some cost and risk share and market guarantee through their transition. So they initiated something called the Contract for Change, which was really a way to support farmers through their transition and make sure they knew that they had a market guarantee at the end of that. And so just to connect this to probably some of the other conversations that you've already had on previous webinars, so how does this then connect to financial services and other types of lending products? Well, lending products are attractive to farmers if, the rates are low interest, if they can be available for annual production loans that can help them invest in productivity improvements plus adaptation mitigation, that can be made available for capital investments. So we think about bringing livestock back into a system. There was quite a bit of capital investment involved in fencing and getting water set up. So, there's another opportunity to create lending structures around conservation practices. They might want the flexible repayment structure, similar to the Glanbia example, or providing some insurance on yield risk that's also tied to their investment in new types of practices. And then these, to bring it back to contracting and the role that contracting can play, these types of products are attractive to lenders if they're coupled with a market guarantee. So farmers can come and show some certainty that if they do these things, they have a guaranteed market. There's can be securitized by the private sector or foundation sort of first loss guarantee, or they can really demonstrate that there's, this is going to result in clear improvements in productivity or access to a premium market. So like an organic market, or if we should get to a point where we can have a really solid carbon market, being able to link those products to a carbon market. And just, to summarize and kind of come back to the main point, in tying this to conservation finance, I think if you can walk away with one thing, it's really that farmers do good things for good reason. And we need to design programs to address kind of those different types of barriers to adoption, and couple that with the right kind of financing mechanisms that can address kind of these win-win, worse before better, or higher production cost scenarios. And I think what we notice at the Food Lab is that people are getting really good at designing kind of the basics of good supply chain programs, but those programs are not always connected to what else is happening in the sector. So the incentive piece is not aligned really to pull together. So I think the call to action for our different communities is really to work to align supply chain programs, policy, conservation finance, so that we're all pulling in the same direction. And that's it. Curious for questions. I haven't been watching the chat box, so.
Thank you so much, Elizabeth. Really appreciate it. What a powerful array of different tools and approaches that you all and your partners are already out there implementing. Yeah, as you said, we have had a number of questions come in while you were talking. And let's go ahead and shift gears over to Q&A. We're not going to be able to address every single question, but we'll try to cover a representative sample. So a first question that I've got here from Tim, who's listening in. He asks, could you explain why you think companies like Danone are using cost-plus programs? What are the brand or corporate incentives to engage in these types of farmer-forward contracts?
Yeah, well, so I can't speak directly for Danone, and also I want to ask if you could take Don off mute so that he can chime in if needed. But I think, cost plus programs, it's an arrangement that allows, for a company like Danone to have a reliable and efficient supplier. And I think that is, I've heard them talk about their program, and they'll say, if we look at market fluctuation and look at historic price paid, we'll see that, over a 10-year period, we come out about the same. So this is a way for us to manage costs with our producers. So there's, one of the potential downsides for farmers in this arrangement is that they have to, they have an open book arrangement with their customer, and it really focuses on, reviewing production costs and pushing for efficiencies. But it also means that there are opportunities for a company like Danone to bulk buy inputs, bulk buy feed, try to reduce those costs together with their farmers. So I think for them, the motivation is really having that reliable, efficient supplier, and then through that relationship, being able to really work with those farmers then on the next step of environmental improvements.
And I would just add, Elizabeth, there is a bit of a history of farmers feeling frankly screwed by cost-plus contracting, because the open book is sometimes accompanied by pressure to reduce costs every year. So I think we just put it out there as one of the tools that works well in some situations where there's a relationship around mutual goals that's linked to things you want to accomplish in the supply chain. And there are examples, for example, in some egg production chains, where it's given the farmers the opportunity to do much better investment because of that stability in terms of pricing. But the key is, what are the tools that help share the costs and risks? And then there's different contracting options out there to serve as tools.
Great, thank you, Don. And another question that kind of extends in that line from Zoe, who's listening in, was just like, how exactly do we know that those farmers are investing money in more sustainable practices, that money that comes through the Cost Plus program? How are companies ensuring that connection, and why are they going that extra step of ensuring it ties to more sustainable practices and not just supporting the farmers financially?
Yeah. So with a company like Danone, they've made a public commitment to reduce their greenhouse gases. So they're using measurement tools with their farmers in their program to be able to report publicly against those goals. So they're motivated to set up programs with their farmers to help them adopt, get more efficient at input use, as well as invest in some of these land management changes like cover crops and minimal no-till systems.
Great. Another question, a little bit of a context here. So someone asks, beyond the examples listed, I believe that General Mills, Kellogg, and others have been supporting a transition to organic farming for a few years now. Interested in your perspectives on this.
And what is the question specifically?
Yeah, so they're just curious, kind of the SFL perspective on the efforts of those companies to support transition to organic, and kind of how that fits into the set of approaches that you are talking about, and what your involvement in those types of partnerships has been.
Yeah, well, that's a great question. I think General Mills has been a leader in trying to understand what the barriers are for transition to organic agriculture, and then trying to build programs and transition support services that can help farmers overcome those incentives. So I think from a food lab perspective, they've been doing taking the approach of listening to producers and asking farmers what they need, and then designing programs around addressing those needs. I don't think that they've taken a particular contracting approach, like an organic valley approach, where they've really put an additional premium structure in place to help with transition. But they have, they're also very involved in the collaboration to develop the ecosystem service market for carbon and other ecosystem service benefits, and are piloting that in some of their conventional markets as well, in particular a wheat pilot in Kansas.
Great. One bigger picture question from the audience. For those folks not well versed in the space, why can't we rely on federal programs like EQIP to drive farmer adoption of more sustainable practices? Like, why isn't that working at the scale we need it to?
that's like a whole nother hour-long conversation. But I think, so my particular perspective is that, so one, the EQIP programs are typically underfunded. Two, not EQIP programs typically reach early adopter farmers. So I think our assumption is that farmers who are already thinking about a practice change and are willing to seek out, to actually take the time to go to an NRCS office, and, are not afraid to enter into an agreement with the government are the types of farmers that are taking advantage of EQIP dollars. So I think there's some limitations in terms of the types of farmers EQIP can reach. And then, as I mentioned in the crop insurance example, there's a whole host of reasons that just kind of push back against those good incentive programs that are sort of, providing a whole different set of incentives for farmers to do things differently.
All right, another question here. Coming in from Gordon, who's listening in. He asks, when food companies invest in new initiatives, for example, transition loan programs to farmers, do they make those investments with capital off their own balance sheets? Or are there examples where third-party investor capital is routed through food companies for these initiatives? And I think you started touching on this a little bit in your loan financing discussions.
Yeah, so that's a great question. So I think there's a couple good examples out there right now. Danone just launched a big initiative with an organization called Replant to do this type of financing. And I think that I know that there's also some transition programs out there that are financed through like a supplier and a banker relationship, where because and organic is different, because from a lender perspective, they know that if they can that farmers are going to be able to access a premium market after they go through the transition process. So there's it makes them more attractive to a lender. And then there's also examples within companies. So I use the Organic Valley example, where they will just work directly through their support that transition process. And the reason why they can do that is that they'll establish sort of that premium based on the length of commitment that they can get from that farmer. So the longer farmer in transition's commitment is to supply Organic Valley, sort of the better the terms can be in terms of what the premium is that would get paid back to paid to support that farmer through their transition.
Great, thank you. Another one coming in here from Lily. She asks, many of these multi-year contracts are to mitigate risk for farmers, but if they're completely tied to one company, such as Oatly, doesn't that introduce new risk of dependency on a single buyer? I think you started touching on this a little bit.
Yeah, so that's a good question, and it really underscores the importance that as we develop these types of contracting programs, that we're also developing sort of multiple market opportunities. So in the corn belt, what's really needed to drive kind of more oat production or small grain production is that there are market players out there like Oatly who can make those kinds of commitments to farmers, but farmers have secondary marketing options. So the feed market is a great example. So as an organization like the Food Lab, we need to work to make sure that it's not just, we're not just setting up a similar system, as you pointed out, with these new sort of risk of dependency on a single buyer, but that we're trying to bring the whole sort of sector in that landscape along to provide these multiple market outlets.
Elizabeth, if I could add to that one, like when, this is Don, Elizabeth's colleague at the Food Lab, when we work in the developing country space with smallholder producers of cocoa and other crops, we work with companies to make sure we don't source more than a third of the production of a co-op, to make sure that a cooperative has multiple sources, multiple buyers, and they're dependent. But you're trying to buy enough from a single co-op or group of farmers, so you provide that financial support for the change in practices. So it's a real balancing act, and we really work with both the farmers and the companies to figure out what that's going to work, what's going to work in a particular circumstance.
Great. Thank you, Don. And one of our other listeners, Irene, had a question in that vein. She was just wondering whether you could expand a little bit on the Ben & Jerry and the cocoa example that you all are working on.
Sure. So I think, as many people are probably aware, cocoa has a number of concerns around it. One, the bulk of cocoa comes from West Africa, where there's concerns that's driving deforestation. There's poverty and food insecurity in the grower base. There's concerns about child labor and the whole rest of the development challenges. So Ben & Jerry's, I think, like companies who get serious about this, their first step is to figure out where are the farmers we source from, and to create more direct relationships with specific cooperatives that serve them. And then what they've really worked on is to figure out how to bring in opportunities for farmers to invest in both things like cook stoves and in reforestation, agroforestry, because those are key things to reduce the pressure for deforestation. And then for them, realizing that farmers have to at least get some minimum return from cocoa that gives them a good return on those investments. So they've really promoted fair trade and been behind the increase in the fair trade minimum price, one of the stakeholders behind that, to make sure that farmers get a sufficient return from their cocoa trade to be able to make investments in their future. So that's the kind of thing that we see is super important. It's company programs can't solve everything. They're just one tool in our toolkit. But what they do is they connect the trade, they connect the returns on production to the investments that farmers can make for both conservation and livelihoods. And we still need that wraparound of other support programs from government and civil society. But the problem is, when the trade is not connected, then often prices wind up going down the more support farmers get, which creates a really a negative balancing loop against that program.
Great. Thank you, Don. So another question for Elizabeth. How do you think the current crisis will help or hurt these initiatives? Companies need to conserve cash, might suggest that reduced funding for these services could occur, but consumer demand might be pushing them in the opposite direction as people become more aware of how the food supply chain operates, given recent press coverage. Curious on your thoughts.
I think we're still trying to understand what this moment and means in terms of, future ability to invest. COVID has really revealed kind of both the importance of the food system as well as the vulnerabilities, and, has caused disruptions that we're really just starting to gather an understanding for. So, retail and food service has shut down and has had huge ripple effects for fresh produce. We've seen increased consumption of, processed foods, which means, and hoarding. So big kind of short-term demand for grains. It turns out that the meat sector is extremely vulnerable. That markets are extremely fragile when they're tied to exports, and in particular, largely driven by biofuel. And then, we have a really good local example. The Food Lab, our offices sit on a small dairy farm that's very dependent on supplying milk to make artisan cheese, where they can get a higher price for that milk, and the cheese is a much more expensive value add item. It also turns out that fancy cheese is a luxury item. And so in our local food systems that are very dependent on profitability from those luxury items that have a sort of a higher value, we've seen those drop in demand and create fragility locally as well. So, I think the basic ingredients, that primary takeaway that, we really need to make sure that farmers are supported to have the ability to invest. I think that's really remains unchanged, but as to kind of what types of new food systems are going to emerge from this moment, I think we're still trying to understand that. I'd be curious to hear what Don has to say.
You summarized that well, Elizabeth. We're still waiting for the other shoe to drop, and the trends are contradictory and confusing at the moment.
All right. So no clear indications yet from any of SFL's partners in the corporate space.
The only thing I would add is just to say we have seen particularly the larger companies continue their commitments to climate change programs, livelihood programs. So while they're dealing with real challenges on new fronts, like in the dairy, we have not seen a step back from the long-term commitment to dealing with climate. Again, these companies aren't perfect, but I think we've been impressed that we have not lost the focus on climate change.
Great, thank you, Don. So a question from Siegfried. I'm not sure I pronounced that correctly, but he asks, thanks for a much needed farmer-centric approach. Do these findings also apply to fresh fruit growers and the produce chain? Do you see a big difference between row crop farming and fresh fruit with regard to these corporate partnerships, food companies, and how they can support farmers?
No, I don't see any difference at all. And I think produce farmers are just as much in need of having kind of multiple markets and multiple markets for more than just one crop. So I think that there isn't a big difference.
Great. And we're going to have one more question here, and then we will wrap up because we're approaching the end of our hour. So this comes in from another listener asking what role should and are these CPG companies who are consumer facing as well, what role are they playing in educating consumers about supply chain practices and specifically farmers' conversion to more sustainable practices? Or is all this work that you're talking about doing with them really not intended to translate to a different story to consumers?
I think companies feel really challenged to communicate the complexity of a soil health story to the consumer on the back of a cereal box or the back of a milk carton. So I think where they can, they're really trying to figure out how to elevate what they're doing. Most of them are not intending to put like a certification on pack or anything like that, that says, like this Frito-Lay chip bag is reduced X number of greenhouse gas emissions. I think that's not their intention. But at the same time, they recognize that they have a really sort of captive audience, and trying to take the complexity of a farming system and a farming story and not get pilloried for greenwashing, and also being able to communicate just the amount of time and the number of cropping cycles it takes to support change. And I think that they really are struggling with how to do that in a way that is simple enough for consumers, but doesn't create a whole host of other sort of unintended consequences from telling that story.
And a quick follow-up to that, which departments, which units and functions within these food companies is SFL partnering with? I mean, are your primary contacts in the sustainability groups or CSR groups of these companies, or primarily working with the procurement teams or finance, or how does that internal politics and connections play out for you all?
Yeah, we're mostly working with the sustainability teams, and then we're helping them translate their stories across the different types of internal stakeholders that they have to pull along with them to make these programs really work. And in some cases, companies are trying to embed sustainability in their commercial teams. So I think that we see in some instances that those two functions are more closely connected, but it's certainly kind of a mixed bag.
Great, thank you. So Elizabeth, before we wrap up, do you have any final comments, thoughts that you want to share?
I don't, just that I think clearly I do. Just that my own sort of personal perspective is that we frequently get distracted by kind of the next shiny new thing, and to always, which has lots. There's lots of potential with in the innovation space to help unlock more change, but to just always remind people to kind of bring it back to trying to understand what the farmer perspective is and how to translate that across the different sort of incentives and structures that are in place that may that they need to overcome to achieve some of these goals.
Great. Thank you so much again for your time, and thank you all for joining us. That concludes our webinar on driving more sustainable agricultural practices through the market power of food and ag companies. Elizabeth, thank you so much for joining us today. For those of you listening in, if you want to share this with others or look back at portions of this talk, you'll be able to view a recording of this webinar on the events tab of the Yale Center for Business and the Environment website, or you can find us on our YouTube channel. Thank you for joining us. Until next time, this is Charlie Governale from the Yale Center for the Business and the Environment.
Thank you.